Keeping your money safe, avoiding narrow markets. Hey everyone, it's Wolfgang. So let's talk about what's been happening in markets. Sort of reminds you of trying to walk in deep grooves of dried mud, like on a motocross track after a rain, in a field after a rain, where there's like deep grooves of mud. Your progress is constrained by deep narrow grooves of mud. It's hard to make any progress. You're getting tripped up by narrows. That's kind of what the market has been. So narrow markets will change with a broadening out. So for example, if you have been watching market action and you knew, for example, that Nvidia, one of the Magnificent Seven, was announcing results, you may have sold large exposure to tech stocks either before or right after those results were announced. Reason being, there's so much uncertainty that even good news will not help the market. So narrow markets, just like people try to get away and avoid trying to walk in narrow, deep grooves of dried mud, markets will change. Investors will seek a broader option, a broadening out. No one believes 7 companies can make an entire market or economy. The Magnificent Seven has been keeping people distracted for a while. The reason for the broadening out, there's too much success and effort in the rest of the economy to ignore. The economy generally is made up not just by 7 companies, but by a huge number of businesses. And so investors tend to seek a broadening out. They get tired of being constrained by a narrow focus. It doesn't last forever. That's not to say artificial intelligence will fade away. It won't fade away. It'll keep increasing, but the market will too. The market for investors is broad, and people will start seeking broader options. Investors are abandoning the narrow choices. As an example, okay, if you've been watching the market action, and you either sold before Nvidia announced results or immediately after, maybe you were watching the QQQ, Exchange Traded Fund. That's the top 100 NASDAQ stocks, top 100 largest NASDAQ companies. A lot of those are tech stocks. It has been falling since the end of October, right? So if you've been watching and you've been interested in keeping your money safe, you might have said, okay, I'm seeing sell-off in, this Exchange Traded Fund QQQ, it's widely held. It's been selling off since the end of October for almost a month. It reached a 2-month low today. So it's been selling off, and it sold off so much it got down to a 2-month low today. And the VIX is up to over 26. Anything over 20 in the volatility index means that the market is uncertain. Okay, investors have some uncertainty. So investors are seeking a broader set of options in the market. They're tired of walking in narrow grooves of mud. They feel they're getting stuck. And that's why there have been, technology has been getting sold. Now, I want to make this clear. Artificial intelligence, it's here to stay. It's going to continue growing, but the time for a narrow focus is behind us, okay? And the proof of that is when Nvidia announced great results, it did not help the broad market. Nvidia is only one company. It did well, fine, right? But that's not the entire economy. That's not the entire market. So the VIX is high. People are trading out of these narrow grooves. They want more options, and there are more options. The economy and the markets have a huge number of options of successful businesses, successful people, a lot of very smart people. There's lots to choose from. There's no need to be narrowly focused. I've been talking about staying diversified for pretty consistently, noticing artificial intelligence like anybody else, but sort of preaching consistency and diversification. So what to expect in markets? Okay, one thing, private credit blowups. Okay, private credit has been in the news, and blowups in private credit have been in the news. Okay, private credit is not regulated like banks are regulated. Private credit's not regulated, not nearly as much. I mean, there are rules, but it does not have the regulatory scrutiny of the conventional money system, lending and stuff. It's also not transparent. It's hard to know what's going on in private credit markets. And then all of a sudden you hear about a blow up. Like BlackRock just took over $150 million in losses from a private credit situation. So what to expect in markets? Private credit will continue to have these blow ups. The narrow market of the Magnificent Seven, that's going to come to an end. It's in the process of ending now. And, you know, people are going to rationally say artificial intelligence, it's great, it's here to stay, it's growing, but it's not the entire market. And it's not diversified either, right? Rational investors will buy the broad market. So what are your choices? The Standard & Poor's 500, there's an ETF called, this is one of the ETFs that tracks the S&P 500. SPY is the ETF. The health of the economy reflected in the S&P 500 is a broad selection of stocks. It's diversified. It's not the narrow Magnificent Seven. So the Magnificent Seven companies have sort of had their day. This is just my opinion. Okay, so take that for what, you know, weigh that carefully. I'm not saying the Magnificent Seven companies will not do well. I'm just saying there are more options than the Magnificent Seven. Nvidia reported very strong results, right? Last night at the close of the market. And today the market sold off huge. Anyways, why? Why did the VIX go up? The VIX is over 26 now. It was below 20 recently. It's well over 26. It's because there's a broadening out of investor desire. Investors are starting to seek a little more diversification, something I've been recommending for a while. This is not a bad option. While it's true that for a while some companies in a narrow section, artificial intelligence, stand out with huge returns, and even though Nvidia reported really strong results, people are kind of fed up with that narrow range of options. They want they want more choices, basically. So the market sold off huge. Investors know that one company is not the entire economy, right? Nvidia is not the entire market. It's not the entire economy. They're doing great. Cool, right? But there's more to choose. Investors have capitulated and will now invest in a more diversified set of assets. This will probably not include private credit. So if you're thinking about, if you're being pitched to invest in private credit, like some people are, weigh that carefully. Talk to your financial advisor about that. Personally, I would not recommend it. The S&P 500 is a diversified set of choices. It's 500 companies in the universe of all companies. It's narrower than the Russell 2000 small cap stocks. It's narrower than all the stocks traded. The S&P 500 is still pretty diversified. So let's consider Berkshire Hathaway's investment in Google. So very questionable. Warren Buffett has announced his retirement. Google stock a year ago was $166 a share. When Berkshire bought it, it was up into the 280 range and beyond. So I look at that and I think, okay, if Google was such a great story, they would have bought it a year ago or before when it was 166. They waited until it hit over 280 to buy it. That does not sound like a Warren Buffett move. So Berkshire decided to pay nearly twice the price of a year ago for Google at a time when Google, that's a tech company that's in this narrow band of successful companies focusing on artificial intelligence. So I don't know I think that move was probably not initiated by Warren Buffett, probably initiated by the people in his company who like technology. So where are we with the U.S. economy right now? Okay, so the U.S. economy, the job market, the Bureau of Labor Statistics announced job numbers. You can't trust those, right? Because unfortunately, we have seen chronically, consistently, that those numbers the number of jobs created gets revised downward for a month later. And then another month goes by and they get revised downward again. So you can't, unfortunately, you can't trust those numbers. Those numbers are, I don't know if they're being manipulated or they've just got the wrong people putting those together. It just seems hard to believe that smart people could be so wrong so consistently for so long, such a long period of time. So you can't really trust the job numbers announced by the government, unfortunately. Verizon is laying off 13,000 people right before Thanksgiving. That's the real job market. We've heard about these layoffs for a while now. The unemployment rate rose. So on the one hand, the government was saying a lot of people got hired. On the other hand, the government was saying, but unemployment rose. So I believe the unemployment rate rose. I don't believe the job numbers, the hiring numbers. I don't think there's a lot of hiring in the economy. So unemployment has not been, what they announced for the unemployment number has not been this bad since October 2021, about 4 years. A little over 4 years ago, unemployment was this high as it is now. So let's talk about some better news. What are the catalysts for economic growth right now? We need job growth. We need to unfreeze the housing market. We need a long-term interest rate drop. And we need the Fed to start buying the 2, 10, and 30-year Treasury bonds to lower long-term interest rates, to lower mortgage rates. Mortgage rates hit a high in the last few days, 6.3%. So people are not buying homes. The job market is, in some parts of the economy, is great. In other parts of the economy, anything related to housing, like trades jobs, plumbing, heating and air conditioning, flooring, furniture, appliances, remodeling, new home construction, those jobs are suffering. They've been suffering for a while. So those folks are not buying in the economy. So we need job growth. We need to unfreeze the housing market with lower rates. And unfortunately, the wrong people are inside the body that makes decisions on interest rates. What should have happened probably 6 months ago is that they should have started buying treasuries to put money into the economy, so that and that would lower interest rates. Buying the 10-year would increase the 10 years price, but lower the 10 years yield, because mortgages are based on the 10-year bond. That would lower borrowing rates. That being said, the job market being as soft as it is, I don't think a lot of people are concerned about buying. I think people are focused on, making things work for now. That probably means renting and not having a goal to buy a home. So that's kind of where we are with the market. Keeping your money safe means avoiding narrow markets. So the Magnificent Seven was sort of a shiny object for quite a while. But the cool thing is, if you noticed, for example, things like the QQQ falling since the end of October, if you felt uncertain about the narrow choices in stocks, maybe you decided to buy the S&P 500. If you have a dollar cost averaging approach where you put regular money into the S&P 500 over the long term, you're going to do great. Even Warren Buffett has said, has pointed out, that you'll beat the vast majority of investment managers. If you simply dollar cost average a regular investment in the S&P 500 over time, and you'll do very well. So that's sort of the message for today. I'm sorry if you got hurt by the market sell-off today. I'm sorry if that affected you. Generally, if there's a narrow situation in the market, it doesn't mean the reason is bad. Artificial intelligence is a great thing, right? But it's not the whole market. It does not, those few companies, that does not make up an entire economy. And so even though they do well compared to other players in the market, you have to start thinking about being diversified and not trying to make a killing on a few narrow companies. So if you have any questions about any of this, please post questions in the comments. I'd be more than happy to answer any questions you have. I really want to thank everyone for watching. Have a great day.